Good morning, everyone. I stopped to think about what I'd speak about, and I guess the interesting thing is sort of, I'm a little bit actually worried being here today. If you think back 2 years ago, we were sitting here, and for many of you, for many of us in the room, the word subprime was about the first time we ever heard subprime. It's about the 26th of July, I remember, when it started to happen. And somebody reminded me the other day, of course, what happened 2 years ago is subprime was a little problem, but it was all going to be contained. A year ago, of course, we were sitting here feeling, well, maybe we dodged a bullet, and 6 weeks later, Lehman goes down, and of course, the rest is history. So what I wanted to do today is, I've sort of said I want to, looking back into the future, I don't want to harp on the GFC, because actually it's quite depressing, and I think all of you have had enough of it. I've had enough of it. How many are happy that it's sort of looking a little better today? Yeah, I'm very happy. But I do think there are a couple interesting lessons. And it's sort of, to me, it's a bit, we all spend hundreds of hours looking at business plans and developing things for projects, for infrastructure projects. I remember in San Diego when we built a road, we had it designed for the 1 in 100-year rains. And of course, the next year we had the 1 in 100-year rains. And me being a fairly boring guy, I thought, I wonder whether this really is right, that there are only 1 in 100-year rains. And it's kind of a bit true of the GFC, actually. You know, we're all getting told this is the worst thing since the 30s, but actually maybe you think maybe there's a bit more volatility to come in the world. I don't think it's going to be as bad as it is, but anyway. So I wanted to sort of reflect on that. So now we've got the disclaimer out of the way. It's another feature of the GFC. The disclaimer's gotten longer. It's a little joke, folks. Nothing with disclaimer, McCoy. What is interesting to me about the GFC and really about where the last years come is we moved from an issue in the financial markets to the kind of the wider economy. And I've just whacked up some of the headlines, but of course we all know this has happened. And so it's kind of interesting to think, you know, for a year, if you actually look at, I mean, I sort of said to people, really for the last 2 years, life's been harder, right? It really has been. But for the first year of it, so August 2007 to August 2008, life was harder, but it was okay. Really, the last year has been a whole step worse. And I think really, 2 years ago, it was more the anticipation of what was going to come. I guess because I've sat in the financial markets for years, I could watch a lot of this stuff that had happened that you could just see was going to unwind, the sieves and some of these really highly leveraged structures that were going to unwind. I guess the question was, when was it going to hit into the real world? Well, the thing is, it did hit the real world, or the wider economy. And I think actually there are 3 basic lessons that have come out of it, or 3 points that have come out of it. Number one, actually infrastructure has remained an attractive investment class throughout the period. And I'll talk a little bit about that. But it is pretty critical to understand that there are still lots of money flowing into infrastructure because it is an attractive investment class. The second point is we are going to be in a capital-constrained world for the next few years. There is no doubt about that, and I'll show you a couple of reasons why I believe that. But there are still, you know, banks, finance companies, insurance companies, pension funds are still looking for places to deploy capital. And so there's still significant demand for new opportunities. And the third point, which is kind of, to me, the other interesting piece of the puzzle, is, of course, government resources are going to be constrained over the coming years. I mean, the spend is unbelievable. Amazing when you look at the net debt to GDP figures. They are just mind-boggling. And you have that on the one hand, and on the other hand, as I say, I've been in this business 17 years. I started when I was 6. And the thing is, though, to me, you know, I was in the UK when it all started, right? And the debate, which still goes on in the UK to some extent about whether this stuff's on or off balance sheet, is kind of irrelevant, right? I mean, the truth of the matter is what I firmly believe in, have believed in for a long time, is the service delivery model that we provide through private provision of infrastructure is actually as important as the funding. You know, there are more than 700 PFI deals that have been done in the UK now, right? It is amazing. I lived there in 96 to 2002, and I go back to London every 2 or 3 months to see the number of hospitals, school projects, highways, things that have actually been done and done on budget. One of the numbers that I quote, and I've had this hit me a couple of times, is that the Highways Agency in the UK, which is the sort of the RTA equivalent, or, you know, it's at a national level, when they come up with an estimate, Treasury, Her Majesty's Treasury, adds 40%, 40% to any estimate. Now, I've been involved in something there where we're saying it's going to cost 100, and Treasury says, yeah, okay, it's going to cost 140. We say, no, it's going to cost 100. Oh, it's going to cost 140. No, we're going to take the risk that it only costs 100. And I know many of you in the room who are involved in delivering the projects know that we do that, but I wouldn't underestimate that as the other piece of the puzzle that we'll continue to push through. So it's a bit worrying to be up here in such a volatile time, but I am cautiously optimistic. Maybe it's true if you're going to be, I think for many of you, if you're going to be a project developer, you've got to be optimistic. I mean, it's hard to get out of bed if you're not optimistic, but I think there are lots of reasons why we should be optimistic, and I'll walk through some of them. So my first point is that infrastructure is a good investment class. On the left here, Macquarie in June of 2000 started creating an infrastructure index. So it's just an index of a bunch of infra companies around the world. What we've done is plotted this over the last 9 years against the S&P 500, so fairly broad measure of the market. It is quite amazing how well infrastructure, boring old medium risk, medium return infrastructure, has actually massively outperformed over 9 years. The pension funds of the world look at these statistics and say, yeah, that's good. Equally interesting, of course, over the last 2 years where it's been more volatile, that is the infrastructure line on top. Basically, through the whole period, it has outperformed. And it's kind of interesting because on the one hand, you supposedly invest in infrastructure because it's stable, so you would expect that to happen. But of course, the last 2 years, the biggest issue has been about debt. And who are the biggest borrowers in the world? Well, it's not Macquarie, it's actually the whole sector. But actually, that's what's hit the market. So the investments have held up, and that's what actually, investors look at that stuff and say, we'd like to keep investing. Now, why has it held up? Well, the second point I would make to you is that actually we all get caught up day to day in looking at our businesses. And I used to run MIG. I looked at the toll road numbers every day from around the world from all the roads MIG owned. And, you expected this sort of fairly steady progression of numbers going up. Now, there is no doubt that in the last year the sector's been hit. And obviously we've seen traffic come off on a number of the assets, whether roads, airports, ports. But what I did is I actually went and I picked on airports. And why did I pick on airports? Because airports are one of the more volatile sectors in what we do. Air travel over the last 45 years has increased at twice GDP, 2 times GDP over 45 years. If you draw that trend line, it bounces around it, but it comes back to it. What is interesting, though, is you get, with SARS and things, you do get quite a bit of bounce in the airport sector. So what I had our guys over in Europe just pick up, and sorry, it's a bit hard to read, but they went and picked up the major airports and airport groups all over Europe and grouped them into, this is over the last month that they've reported, ones that actually had positive growth all the way down to ones that had more than 15% drop-off in traffic. Now, there are a couple up in Scandinavia, poor old Sweden and Oslo have had a bigger drop than 15%. But at the same time, actually, Athens, everybody's decided to take a holiday, and Birmingham, maybe it's everybody going from Birmingham to Athens, have actually shown positive growth in the last month. And the really big airports of Europe, ADP, Airport de Paris, which is the group of airports, Orly and Charles de Gaulle around Paris, Fraport and BAA, are all kind of in the down 0 to 5% group. Now, if you look, actually, you think if you're a car manufacturer, I saw a piece the other day that said that Lexus and Daimler were both happy in the U.S. because last month their sales were only down 22%. Right? It does remind you that we operate in quite a stable investment class. And if you come over to Oz, well, actually, Sydney, if you look at the last 6 months, so some of the most volatile period we've had, Sydney's traffic was down 3.5%. Its EBITDA was actually up 2%. So actually positive EBITDA growth. Take Perth, and its traffic's up by 4.2%. So we sometimes do get caught up, and I get caught up in this because I've been involved in lots of the business plans and things over the years. No doubt stuff's down, but on a relative basis, infrastructure's done exactly what it's supposed to do. It's been stable. Most of the problems the assets have had relate much more to